My name is Jake, welcome to the channel. I love dividend investing because it's a true form of passive income. I love investing into businesses that I feel are going to be around not only today, but in 20 years, 100 years from now. I love investing into companies that have competitive advantages or products or services that we as human beings need not only today, but for years and years to come. The type of investments that I invest in are really companies that are really with that mindset that I'm going to buy it today and I'm going to hold it forever. Regardless of what the share price does, if it goes up or down, everything that I do with my portfolio is from the mindset of a buy and hold perspective. I am not looking to buy into a company today and then sell it for a gain in 10 years or in 20 years. The whole purpose of my dividend growth portfolio is to pay for my living expenses. When I purchase in or become a shareholder of a business, it is intentional so that I'm going to be here for the long haul. And the real goal of my investment here is to see my annual income and the dividend income increase year over year as the business grows and rewards me as a shareholder. The company that we're going to talk about today is not in my cash flow portfolio. So if you're new to the channel, I have two portfolios. I have my cash flow portfolio and I have my real estate portfolio. In my cash flow portfolio, it has your normal sectors here. You got your consumer staples, healthcare, utilities, etc. In my real estate portfolio, it's just real estate. It's just a personal preference. It's not something that you have to do. I just personally like having them separate because real estate or real estate investment trusts are taxed differently here in the United States. And for me to plan my taxes, I like to have them separate in terms of in a different portfolio. So it's not something that you have to do. It's really just a personal preference. So in this portfolio, I have it set up very similarly. In today's video, I want to review a company that I plan to buy and hold forever. And this company is in the healthcare sector. A couple of months ago, I shared an entire video on Omega Healthcare. This is my favorite healthcare REIT. If you're not familiar with what a real estate investment trust is, I've left a few links in the description below where you can reference back and see a few other videos that I made on real estate investment trusts. So I'm not going to explain what a REIT is in this video. For the remainder of the video, I'm going to focus on three topics. The first is going to be on the healthcare sector itself and what that means. Second, we're going to dive into MPW. We're going to look at the dividend metrics over time, historical charts, performance. We're going to look at how MPW is taxed. So if you're here in the United States and if it's in a taxable account, what kind of tax treatment could you expect? And then we're going to dive into MPW's portfolio. So when I mean portfolio, I really mean their buildings. Where are they located? How diversified is their real estate portfolio? What does that look like? And then third, we're going to compare the historical performance of MPW to the S&P 500. The important piece here is going to be on the total return. So not just on the dividend, but also on the capital appreciation. Because as an investor, we want to make sure that we're comparing the results to the total performance over time and not just the dividend. When I look at the healthcare sector for REITs going forward, I see that there's going to be an ever continuing demand for healthcare REITs simply because human beings, you and I, there's a lot of smart people out there. But there's also a lot of not so smart people out there. And so there's always going to be a need for healthcare. For example,
1, 2, 3.
Okay, all right, hold on.
Oh my gosh. Okay, so there's 4 different types of healthcare REITs. The first is senior living facilities, second, hospitals, third, medical office buildings, and fourth, skilled nursing facilities. MPW focuses primarily on hospitals. There are other REITs out there that focus on 1 or 2 or a combination of these 4. So it's important to understand that that not all REITs focus on the same thing. When it comes to understanding REITs, I really like to use allreits.com. It's a great website for free information when it comes to all things real estate investment trust. There's other websites out there that give, partial information about REITs and, the screens that are available. It's completely free. I've been using this website for a couple of months now. I've enjoyed it so much. I actually reached out to the developers and just wanted to congratulate them with, it's just an amazing site. And the reason why I love it so much is it's free. You don't have to pay for it. If you use other websites, they try to charge you for it. And I thought a lot of you following the channel are do-it-yourself investors. And so I think if you're interested into real estate investment trust, this is by far, in my opinion, the best website out there that you can do to gather insight around investing into real estate investment trusts. So as I mentioned, it's really for your do-it-yourself investor. If you want to check it out, I'll leave a link in the description below. I'm a huge fan of it. And another cool thing about this site is they break it up by sector. So if you're interested in different sectors or different parts of, a certain sector, right? The skilled nursing, senior housing, hospital, you can check that out specifically. And it blows my mind away, everything that they have here. It's such a great website. So when you click on healthcare as a whole, you're going to find that there's 17 REITs available that they have here in their database. But I focus primarily on these two fields here, and we'll get to the bottom part in a second. But what I like to look at is the price by funds from operation. This is once again how expensive they are. So the higher the number, the more expensive the company is, the higher valuation. So there's less value to be had at this end, but there's more value to be had on a price, by funds from operation, over on this end. So you can see here Omega Healthcare, here you got MPW, and over here you have their overview score. I mean, I could spend an entire hour reviewing this website. Maybe I do it in a future video, but I would recommend checking out, how they come up with these different scoring. It's on their website. It's pretty cool. You can check it out. So if you look at just the healthcare sector as a whole, you can see that Welltower is by far the largest by market cap, and MPW is right here. It's the fourth largest, just above Omega Healthcare. And if you look here in terms of, how expensive they are, you can see that MPW trades at a very, very fair valuation. I really, really like this. Paying less than 15 times their funds from operation, this is a very great value. So if we look at the dividend growth over the last 5 years, you can see that MPW has grown its dividend just over 4%. But what I think is really interesting, over the last couple of years, especially with the pandemic, a lot of these healthcare REITs were forced to cut their dividend. But with MPW, they actually haven't cut their dividend here during the pandemic. So this is really, really interesting. This alone adds a lot of perspective when you're looking at different healthcare REITs. So I'm going to head over to Seeking Alpha and I'm going to get the remaining dividend metrics around MPW. If we look at the last 4 years, if you were to dollar cost average into MPW, you would get just over a 6% dividend yield. And if you were to scroll down here and you were to take a look at, this dividend yield chart here, you can see that MPW is currently yielding about 5.5%. A lot of you following the channel are not lump sum investing, meaning that you're not investing a large amount all at once, but rather you're investing on a regular basis every week, every month, once you get paid from your day job and you're investing into your portfolio. At least that's how my wife and I do it. I assume that a lot of people are like us, they have a day job. And so you can assume that over that time period, you're going to get between maybe a 5 and a 6% current dividend yield by dollar cost averaging into MPW. Now let's take a look at the dividend history of MPW. They've increased their dividend over the last 8 years, and they've been paying a dividend consecutively for the last 15 years. Now, one thing that I would say, if I were to be constructive with MPW, where I'm going to say a lot of nice things about this company. I'm very long on the company. I think it's a great company. It's a buy and hold forever company for me. The only thing that I think is a little bit unfortunate, had I been an investor the financial crisis is that during the financial crisis, before they cut their dividend, they were paying 27 cents a share on a quarterly basis, and it took them about 10 years to get back to that financial crisis level. That is the only thing that really gives me a little pause when it comes to MPW. But as it stands, they've done an incredible job at growing their funds from operation year over year and expanding their business and diversifying their business, which we'll get to in just a second. The last thing that I want to take a look at here is the estimated dividends that you're going to be getting if you're a shareholder over the next coming years. Here in 2020, for every share that you own on an annual basis, you get $1.08. In 2021, this is estimated, right? Because we're still in 2021, it'd be $1.12, and then 2022, $1.16, and in 2023, $1.23. This is what I love as a dividend growth investor. You're getting a high starting yield of 5.5%, but the business is still growing and rewarding you as a shareholder in the form of a growing dividend. And that's what I absolutely love as a buy and hold investor. And then lastly, around the dividend metrics, this is over at allreits.com. You can take a look and see all the different metrics around the company itself, the funds from operation, the price, the market cap, the dividend history, that we just saw here on Seeking Alpha. And this is a thing that's really cool that they offer. A lot of other websites don't offer this for free. All REITs does, which I think is really, really cool. And they list the ranking of this company. And they do this with an algorithm based off of the different criteria, years since IPO, funds from operation growth, etc. But I would recommend you go over and you check it out yourself, and you can play around with it. But what I want to highlight here is two fields here. This field and this field. The financials, this is what I mentioned. To get the financials all the way back to 2015, a lot of different websites will actually charge a premium service to access this information. This website will offer it to you all for free. It's pretty cool. But this is kind of cool. What they do is they put in a hypothetical here. So if you invested $10,000 today at a 5.33 dividend yield, and you would get about $533 a year in dividend income. And then if the company were to continue to grow it in the next 5 to 10 years, you could expect to get $626 in annual dividends or $705 in annual dividends, assuming you didn't reinvest the dividend and you didn't add additional capital to your investment. So it's kind of cool to see what the projected growth would be based off of historical numbers. But as always, we know historical numbers are no guarantee of future numbers. So let's move on and let's take a look at the dividends, how they're taxed. If you're a US citizen here and you pay taxes in the US, if you were a shareholder of MPW in 2020, you would have paid about a little over 40% of that dividend would have been returned to you in the form of return of capital, and about 55% would have been calculated as ordinary income. If you're not sure what return of capital is, I would recommend checking out the other videos that I've covered on how your dividends are taxed. I'll leave the link in the description below to that video. You can check that out. The reason why this is important is return of capital is actually taxed much more favorably, assuming that you never sell your shares. So if you hold this in a taxable account, it's actually not as bad as you would think. It's only, a tax burden when you sell it, but if you never plan on selling your shares, this could actually not be a bad investment for a taxable account. It doesn't necessarily have to be in a tax sheltered account like a Roth IRA. So obviously this is just my opinion, but it's something to definitely consider. Now let's take a deep dive into MPW and really look under the hood and see what you're getting as an investor of MPW. They currently have 446 facilities in 9 countries, and they have just under 50,000 licensed beds. This is not a small operation. This is a very large company when it comes to what they're doing in the hospital space. So if you go down and you take a look at their capital allocation, 72% is in general acute hospitals. This would be your hospital that you would go to if you broke your leg, you had a medical emergency, you need to go to the ER. This would be, 72% of their portfolio. Just under 11% was in behavioral health facilities. Just under 10% was inpatient rehabilitation hospitals. And then you got long-term acute care hospitals and freestanding ER and urgent care facilities. So this is how they're diversified in the type of hospitals that they have in their portfolio. When looking at the different countries that they're investing in, this is something that I personally really, really like, is that 61% is in the United States. The majority is in the US, but they're also diversified in very well-established developed countries. Just under 20% in the United Kingdom, 6% in Germany, 6% in Switzerland, just over 4% in Australia, 1% in Spain, and others. The reason why I like this is a lot of other countries have more stability when it comes to their healthcare system. Here in the United States, the political situation is a little bit wonky, especially if you're, an international looking at and seeing how the U.S. has set up their healthcare. I really like the fact that 40% is diversified out of the United States. And if you look at the United States coverage, 10% is allocated in Texas, just over 7% in California, 6.5% in Massachusetts, just under 6% in Utah, 5% in Florida, and then, 23% in other states. So I like this. And the reason why I'm sharing this is I was reading their annual review, their quarterly reviews. I'm a nerd like that. I read it so you maybe don't have to. I don't know, but I just really enjoy it. And when you listen to their earning calls and when you read their annual reports, they highlight over and over again how well diversified they are as a business. That's the cool thing about MPW that makes me so bullish about this company, is how well diversified their portfolio really is. It's not that they're just in one state, in one country, in one space, right? And we learned about the different types of healthcare REITs that are out there. They're very well diversified, and that makes me so bullish as a long-term investor. So we look at one example of one of their hospitals here in Massachusetts, for example. They acquired it in 2017, has over 300 beds, right? And it's one of those buildings that if you type in the address, you can actually see it. This is Google Maps right here. You can actually see it. It's a physical structure. It's tangible. And that's what I love about investing into REITs, is it's tangible. You can see your actual investment. And I love that. So if you've stuck with the video this far, I'm really excited, because if you're a nerd like I am, this kind of stuff is so important. So if you watched my other REIT videos or real estate investment trust videos on other companies that I've reviewed here on the channel, this is probably by far the most important thing when it comes to investing into real estate. If you've ever invested into real estate yourself as a do-it-yourself landlord or whatever, you know that the lease is so impactful on your returns as a real estate investor. And so the way that their lease is structured, it's structured for predictable cash flow. 87% of their leases end after 2030. 87% of their leases are over a 9-year lease term. This is absolutely massive. And this is what makes this type of investment so passive and such a long-term investment, is these lease terms, these contracts, they have in them contractually, rent escalations. The long-term lease structures of MPW really makes it an attractive investment for a long-term investor. If you're not familiar with real estate, or if you never invested into real estate, I can't stress this enough of how important this is. The last thing that I want to touch here is their debt. They do have a sizable amount of debt, but it is 96% of it at a fixed rate. And so you can see the notes, and when they're callable, that they're at low rates, right? 2.5% up to 5%. And you can see how they mature over the next, 9 years. And I think this gives me as a long-term investor a lot of peace of mind that this is set up in a way that is not going to be maturing all at the same time. So this is very important. Now let's take a look at how MPW has performed against the S&P 500. If you would have just invested in the S&P 500 compared to MPW, what would your total return be? The total return is the capital appreciation plus the dividend. So the dividend reinvested, right? That's what total return means. If you invested 5 years ago a lump sum of money, you'd be up 78% with MPW. If you invested that same amount of money into the S&P 500, you would be up significantly higher here in the S&P 500. Now you can see that the chart has kind of, tracked the S&P 500 to, they started doing better during, the start of the pandemic, but because they are a healthcare REIT, and because we're seeing a lot of new cases come up, there's a lot of fear in the market, and it's putting a lot of pressure on the share price of MPW. Now to get a bigger picture, I want to kind of zoom out and see what the total return would look like if we expanded not only 5 years, but if we looked all the way back shortly after they went IPO. So if you invested $10,000 into the S&P 500, you reinvested the dividend, but you didn't add any additional capital, you would see what we're looking at here in the bottom right, the annual return. You get just over a 10.5% annualized rate of return. So 10.5% annually from 2006. That's a pretty good amount. If you were to do the exact same thing with MPW, if you look in the bottom right here, you can see that you're getting just under a 13% annualized rate of return. Okay, so in this scenario, with this time frame, you actually beat the S&P 500 in terms of the total return with this time period. Now let's take a look at another scenario here. If we were to look at 6 years, right? If you were to invest the same amount here in 2015 in January, if you did that with the S&P 500, you would get an annualized rate of return of over 14% with the S&P 500. And if you did the exact same thing with January of 2015 with MPW, you would get just over a 12.5% annualized rate of return. So in this scenario, the S&P 500 would have outperformed the MPW. But in the other scenario that we used a second ago from 2006, you're actually beating the S&P 500. So the timing does matter, and I share this to really just not to confuse you, but just to kind of share that the timing does matter when comparing the results. So it's not just a blanket statement, the S&P 500 performed better than MPW, or MPW performed better than the S&P 500. And once again, we're comparing historical numbers here. There's no guarantee of future numbers, but I think it does matter when looking at the time frame when comparing the two. And that's why I highlight both of those. Now, I know everybody's not going to get as excited as I do about investing into a healthcare REIT or a company that specializes or focuses on hospitals. But I personally love investing into businesses with sustainable cash flows. I love the fact that it has a high starting yield. It's one of the best of its kind in its space. And for me as a long-term investor that's focused on growing my cash flow or growing my annual income, dividend income, MPW is one of the best healthcare REITs out there that you can invest in. And it has a starting yield of 5.5%. And if you dollar cost average over the coming years, you could expect reasonably a 5 to 6%, yield on cost. For me personally, I think this is a slam dunk, and I am so excited to be a shareholder of this company. Thank you so much, everybody, for watching. I hope that this video was helpful. I hope that you learned something new. I hope that I was able to make investing into healthcare REITs a little bit more exciting and really, share the reason why I am so bullish on this company, not only today, but for years and years to come. I hope everybody has a great week, and I'll catch y'all in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.